These reports, they just keep getting weirder. What's going on?
So, I think it was, I forget who it was that I was talking to. Listen, use the household survey for its ratios. Don't use it for its levels. Actually, that was a tweet series by Jason Furman.
Oh, yeah.
I'm remembering now. It is designed to give you ratios of how many people we surveyed were employed, how many people we surveyed were out of the workforce, how many people were participating.
How many were men,
right.
How many were women,
Now,
how many were this age?
That said, I don't think I have my chart with me, but it is an unusual gap. I use a series that is corrected for the different concepts in there, and it's a 4 million job gap. And it is the largest that we have seen.
Because it wasn't just this month. Correct me if I'm wrong. Hasn't this been going on for a few months now?
They went their separate ways about June of 2022. Or January. It's been for a while. It's been growing like this, and of course it's cumulative over time. But it doesn't say you should dismiss the payroll numbers and all these other things. For example, the low jobless claims tell us that the job market is in pretty good shape.
That's a great point, because I was going to ask which is the truer tell. And it sounds like, and Diane, I'll let you speak to this. Do you think that we should just take it at face value? It's a strong labor market still. End of story.
And by the way, I'm listening, Diane, because I really want to know the answer, too.
I do think it is a strong labor market still. The acceleration in wages is something that really was important at where it occurred. It occurred in the service sector, in the parts of the service sector where inflation has proven stickiest. So that's a bit of a conundrum for the Federal Reserve. And, what the Fed has to do in this, it was everything in personal care services, home maintenance, repairs, cleaning, the things, and vehicle maintenance as well. These are all things that have been pushing up inflation in the service sector. And the Fed doesn't want to target wages, but we do know that labor costs play a bigger role in the service sector. And so this still keeps the Fed on the higher for longer path. We expect a December rate cut still. And I think it's important, though, that the Fed is also, a little nervous about how far it can go, especially Chair Powell. There's members of the Fed that were talking rate hikes last time. I think that will be sidelined at this as we see them pencil down their trajectory on rate cuts. And I think, it will be between 1 and 2 cuts when they release their dot plot for the month of June, which will come out. They'll actually write it down after they get that inflation report that they're going to have during the middle of their meeting. So, talking data dependence has sort of gone to an extreme here. But I do think it is important that they're still seeing a stickiness in wages, and wages accelerating in a sector where inflation's been the stickiest. That means you need a lot of disinflation or deflation, drop in prices in goods.
Here's the wacky thing, and on top of the wacky report, that neither one of you
The wacky thing or one of the wacky things?
An additionally
wacky
many
thing.
wacky things.
Among the wacky things.
I won't ask you to comment on, per se, it's a market observation. But so the first text that I got when this crossed was from a trader saying, no cuts before the election. That's out. That's off the table. We all saw the stock market's initial reaction, Steve, which was to dump lower.
Right.
Now the S&P is at all-time highs.
Well,
so explain to me everything Diane's saying, which makes sense, which is, things we need more disinflation, especially in this, and we're not seeing that. You'd think the market would be furious, and instead it's celebrating.
My work shows that the Fed is not reluctant to move in what we call the presidential election season, and that is looking at when and if they move between January and October. They have moved and will move in September. I think the bar is somewhat slightly higher because it is election season, but I don't think the Fed is reluctant to move in that time. And I think if you get,
it doesn't have to do with the election season.
And I think if you get 3 months of lower inflation, I think Lagarde has shown us a way that the Fed can tweak. Look at how well controlled the bond markets have been in Europe after this cut. Not only did they not go down and price in a whole boatload of additional cuts, yields actually went up. Lagarde did this in a wonderful way that allowed her to reduce some of the restrictiveness in the economy, which I think is a good idea for the U.S., even in the face of this higher payroll number, and yet maintain a restrictiveness. Here's the thing. We can have a discussion about this. Powell doesn't think it's possible. I think you can navigate by the stars.
Diane?
Well, he says you can navigate by the stars, just not under cloudy skies. I think that was
right. Correct.
It was cloudy skies that got in the way of those stars, so you can navigate by the stars. I agree with you that the election is not going to determine whether or not, From our perspective, we have inflation cooling over the summer. Not enough until this summer, but then the data on that doesn't really confirm it convincingly for the Fed until October. So that's why we have our cut in December. It could mean a cut as soon as November. I think it's harder to do in September on the timing, but I won't rule out the economy getting weaker either, because I think we're starting to get, the ice isn't cracking yet. It's not completely thin, but I think the Fed is worried that they're going to hit a tripwire. And you always hear that nonlinearity, that word coming out of Jay Powell's mouth, and that is that when the economy goes south, it tends to go south rapidly. And since they are data dependent, they've already baked in this sort of willingness to wait until they actually see it in the data. That's after the fact.
I call nonlinearity.
And I think that's part of the problem.